Welcome to Advisor Wars, the podcast where we take a critical look at the key issues facing the financial advisor profession. My name is Bob Hoopsher, and joining me is co-host Joe Halpern. He is the managing partner and chief investment officer of Obsidian CIO. I was the founder of Advisor Perspectives and led it as CEO until 2024. This is the 10th episode of Advisor Wars and the fourth installment in our series that examines the role of tax planning in the advisory profession. Our topic today is direct indexing, and with us is Dave Nadig, who is the president and director of research for ETF.com. And Dave and I also worked together at Vetify at the same time, where he then had the illustrious title of financial futurist. So Dave, I'm going to ask you just to tell us a little bit about your role at ETF.com and as director of research, what themes have been occupying most of your research lately?
Sure. So, ETF.com is a resource primarily for financial advisors, but obviously we get a lot of retail folks who show up too with a nice URL like ETF.com. And so we produce content to help folks make better choices amongst the 5,000 crazy ETFs that get launched in this, that are already trading in this market right now. As far as the topics that we're really hitting, we're hitting a big one today. Tax planning is absolutely one of the biggest issues we've got. There's a lot of talk about what's going on in the regulatory space as well, a lot of novel and new products coming out. Many of those aren't of particular interest to financial advisors. I don't know many advisors using things like triple leverage and prediction markets, but they are very much part of the ETF ecosystem now. So that's what's occupying most of our time.
And then, Dave, for listeners who haven't worked with it, what exactly is direct indexing, and what problem was it originally designed to solve?
Sure. So I think the easiest way to think about direct indexing is it's just separately managed accounts with a little bit of math on top. And advisors have been using SMAs, honestly, forever, since there have been financial advisors, because it's actually the natural way to manage most wealthy people's money. Somebody shows up in your office and they've got a portfolio. The first thing you do is usually not say, well, let's sell all of that and buy 3 ETFs. You say, let's look at what you've got and let's be smart about what we might sell, what we might buy, what our long-term plans are. A direct indexing approach is a way of taking an SMA and putting a bunch of that money into a portfolio that looks very much like an index, hence the name direct indexing. Very rarely is it precisely the same as an index, but it's close to an index. And then making various tweaks to that index to make it direct, to make it mine, to make it personalized. And the two reasons people tend to personalize that index, to personalize that portfolio, are either for some level of exclusions. Most often it's a single stock exclusion. I'm a senior executive at Alphabet. I don't particularly want to have a bunch more Alphabet in my portfolio. Let's leave that out of my portfolio long term. That's a very common one. Or to manage down that large position. I already have too much Alphabet. I want to slowly get it down towards index weight. Again, that's a natural thing to do in a direct indexing platform. The second big bucket is taxes. By having your own personal index, you can engage in single stock tax loss harvesting, which is just a way of mitigating when you decide you want to pay the tax bill. You're not necessarily getting rid of all your taxes forever. You're just choosing to take those losses at a time when it's advantageous to you from a tax perspective. So long story short, that's where direct indexing fits in most advisors' portfolios.
That's really helpful. And then back in 2020, there was this huge buying spree of direct indexers. I'm going to actually read off the list here. You had Schwab acquired Motif, Goldman acquired Folio, Morgan Stanley. I mean, I don't know if they bought Eaton Vance totally for Parametric, but we'll just call it Parametric. We could come back to that. BlackRock, Aperio, JP Morgan, 55 IP, and Open Invest, Vanguard, Just Invest. I mean, this is a lot. And there's even more than that behind. Why did everybody think this was the next major battleground where everybody kind of acquired it? Like, what were the assumptions going into all these acquisitions back then?
Yeah, I first of all, I want to push back on a tone I've already gotten, which is I think there is this theory in the marketplace that direct indexing was a fad and a failure. That's really not true. Direct indexing is now sitting at about $1.5 trillion, which is about a 50% growth rate since that buying spree started. It sits, hovering around something like 8 to 12% of ETF assets. So that's a pretty reasonable chunk of money here. We're not talking about nothing. I think where maybe people got over their skis was this was sold to the press as an ETF killer, that somehow we were going to enter a world where every human being on the planet was going to have their own personal rolled up ETF-like direct index, and anybody who was packaging a product was doomed. Obviously, that's ridiculous. The efficiencies that you get from pooling investments, particularly in something systematic like an index fund, mean that you can legitimately run the marginal dollar of index money for a basis point or 2 or 3. You cannot do that in an SMA, no matter what you do. It's always going to be less efficient. So that's where I think we got a little over the skis. We did get most of the big guys got bought up. Most of them have had reasonable success. I mean, Parametric's now sitting at $250 billion. Like, they've done very well.
Yeah. So any assumptions? So I guess with your sentiment, the assumptions are that these were all pretty good acquisitions and they served the purpose, meaning that industry kept on growing and these were important components to incorporate within a larger asset manager. Is that fair?
I think that's fair. I wouldn't say they've, like, each one of these acquisitions has been an unmitigated success. I'm sure people would argue about them differently. It's worth pointing out that what was getting bought in each case was different. The Eaton Vance Parametric acquisition by Morgan Stanley was probably the cleanest, in the sense that this was a big extant business with a big extant sales force and customer base. And so Morgan Stanley just bought themselves into that business with a big established player. I would argue Franklin Templeton's acquisition of Canvas, which was the O'Shaughnessy Asset Management direct indexing platform, was similar, and I think has been extremely beneficial for them. I think they've gone from roughly about $1 billion on that platform to 15 was the last number I got in a handful of years. That's pretty darn good. A lot of the other acquisitions, I think you can argue, might not have really been direct indexing acquisitions. Like, I think the Goldman acquisition of Folio was really more about getting access to some custody technology than really going after kind of a retail advised direct indexing platform. I think Schwab's acquisition of Motif was largely irrelevant. That was a business that was largely dying, and there was sort of some technology left on the shelf. So I think those ones are, maybe a little more meh. And BlackRock's acquisition of Aperio, again, I think that's been a huge success for them. I don't think they would argue otherwise.
Yeah.
Dave, you mentioned earlier that direct indexing has been used for purposes such as excluding a stock that someone may already have a position in. What's turned out to be the most common purpose that it's used for? And how often is it used to diversify a concentrated position?
So the advisor, first of all, it's impossible to know exactly, like many things in this industry. So this is somewhat anecdotal. Cerule's done a great study on this. I would say they have the axe in doing regular research on the direct indexing market. And I think it's that single stock exclusion has been the story I hear most often from advisors. So when I talk to a firm that's using Canvas, is what comes up a lot. They've done very well at going after RIAs, and that tends to be where my network is. And the RIAs that I know who've been using Canvas, or to some extent Parametric, they're really using it for that rebalancing an over-concentrated executive portfolio, which is a really common advisor use case. You've got a family with $25 million, $20 million of it's still in company stock, right? That's a very common problem. And what direct indexing does is it doesn't solve your problem out of the gate, although different providers may have different tools to try to automate this. What it does is it gives you tools that work at all for managing that position down, right? If you've got that kind of massive overweight in a single company, well, guess what? You've got a massive overweight in that industry. You've got a massive overweight in that country, right? You are overexposed in multiple different ways. A smart advisor with some good tools and a direct indexing platform not only can create the rest of the portfolio to help offset those massive overexposures, but can help create a really logical plan for when and how you sell down those those positions, given the restrictions you may have, right? You may not be able to sell all of it. You may have to be on a plan that you sell X amount a quarter. Maybe you've got a certain amount you can sell on discretion. Those are important things for an advisor to be working with a client on, and direct indexing gives you a way to handle it. Because if all you're doing with the portfolio otherwise is buying a bunch of ETFs, it's way harder.
And then the second component that you highlighted, Dave, in regards to direct indexing is this capability to tax harvest, which could right off the bat help on the concentrated positions, right? You tax harvest some losses and then sell down those concentrated positions given the right to do it. So really nice package from that standpoint. How should advisors measure that tax alpha?
Yeah, that's a big thing. We got another hour or two. That is a big thorny question that the folks at the CFA and all sorts of other places have really wrestled with. After-tax performance standards, I think, are tricky, and there are reasonable people who have CFAs, which I do not, have arguments about whether or not you're doing pre-liquidation, post-liquidation. I mean, there's nuance here. From the perspective of what direct indexing is bringing to the table here and may help, I would be skeptical of some of the claims that you read as an advisor. If you're looking at DI, you're going to get pitched, oh, we're going to save your clients 1%, 2%, 5% a year on an after-tax basis. And in fact, they'll be able to show you examples where that happens. They're not lying. That's not a thing that can't happen. But I think a rational person who thinks this through will come to the obvious conclusion that you can tax loss harvest very aggressively for a while, and then you run out of things to tax loss harvest because markets tend to go up. This is the high class problem. You do not want a portfolio where you could be harvesting losses on every position every day. That means you've lost tons of money, right? So if you're doing a reasonable job as an advisor, you should be running eventually out of basis to get rid of here. And so it is a very powerful and useful tool. And in fact, with a big, sloppy, messy portfolio that you're transitioning to an index over time, an advisor may in fact be able to get several percent of excess return for several years in that transition. And that's important and valuable. But that's different than the blanket claims you'll read on some of the brochures about, endless free money forever. That is not the case. It is more complicated than that. I will say the opposite is also true. There are people trying to say direct indexing is terrible and doesn't deliver any of these benefits. They're wrong too, right? This is a tool. If you have clients for whom it is an appropriate tool, you will be a hero, but it is not a panacea by any stretch.
Is there a good benchmark? Like, what is the right? You kind of mentioned right at the beginning of that answer. 1%, 2%, 5% in terms of what this may throw off in tax losses. Is there a benchmark to use? Like, how?
I mean, there is the USIPC after-tax performance standards, which I think is the CFA societies or CFA institutes formula for how you do this. It is not super simple because obviously you have to create almost a counterfactual. Like you have to be able to say, well, if we didn't sell a thing and instead, I guess we sold it with correct tax as opposed to deferred tax, you would get this kind of return. You can do it. You really have to do it at the individual security level. It's very complicated. I honestly think most people will simply accept the reporting that's going to come out of their vendor, which is, checking all the right boxes. I don't think there's a big nefarious problem here. I think this is a complicated problem and taxes are very individual.
Okay, and I imagine those who benefit the most from these vehicles are most likely either people with very concentrated positions or just very high tax rates. Is that accurate? Is there any other type of clients you think of that benefit the most from these products?
If you actually want to be more active in your portfolio, meaning if you want to be able to say to your advisor as the high net worth person coming in, I want to maintain something close to equal weighting, right? That obviously now has an implication that you're doing a ton of trading because you're constantly selling your winners and buying losers. May or may not be a great strategy, but in a direct indexing platform, you could do that with some better tax advantage than just raw buying RSP and just whatever happens with the taxes happens with the taxes. So you can be more specific when you've got a thing you're very carefully trying to do. Yes, if you're managing big concentrated positions, it's not so much even the taxes that are beneficial, it's the utility of being able to manage that portfolio systematically down over time that most DI platforms give you. I think that's the real advantage there, but doing it in a tax aware sense, I think is a big win.
What does this cost? What are the fees? Do they consist of basis point fees or platform fees or some combination?
It's a little all over the place. Like, I mean, I think roughly you're talking about something like 20 to 40 basis points over an advisory fee, right? So you can think of that as replacing the investment advisory fee. Now, that's complicated by the fact that under most DI platforms, things like your fixed income allocation are probably going to get bought through a mutual fund or an ETF. They're not going to necessarily go DI your bond exposure, which would be a nightmare for most individuals. So with the caveat, there'll be some acquired fund fees and expenses. 20 to 40 basis points probably gets you into where most people are. Now, obviously, a bunch of costs are going to be higher than that when you look at the rack rate. If you walk in the door at like Fidelity, I think their top out of the gate is 40 basis points on top of what you're paying to your advisor. But those things all are negotiable and can come down, and minimums have come down. I think some folks have minimums of $2,000. I think at Schwab now, if you want to try their version of direct indexing, I think it's sort of silly for people to be targeting very small portfolio values. I think this starts to make sense when you're at the million to multiple $1 million in a single equity portfolio. That's when it starts making sense to own the individual positions.
And Joe asked about benchmarks earlier. I mean, really what you're doing is you're delaying the payment of capital gains tax. So the alternative would be to simply sell that concentrated position, pay the capital gains tax at whatever rate your marginal rate is now, and the comparison is what the benefit would be selling it later on. What are some of the risks? I think you touched on tracking error. There could be a change in the tax code or tax rates. What are some of the risks that direct indexing will not play out as you planned?
Well, so the biggest one is probably what some people call the tax trap, which is that you can end up in a situation where you've exhausted all of these sort of easy losses that you can use, and you end up with a portfolio where every single transaction is now just going to be taxable by definition, because everything that you're holding is just, you've used up all that juice. You don't have any losses left. So there is that. There's obviously misallocation mistakes that can be made. You don't want to really be doing this in like an IRA or a 401k or something like that. It's sort of a misallocation of the tool for some of the advantage. So there's some of that that's in there. Obviously, if you're in the business of selling things at a loss, you're potentially introducing not just tracking error, but you can just be wrong. Like, I mean, you can literally just be out of stocks and out of sectors just as they come back into favor. And conversely, if this is happening as part of a systematic rebalance, you can be wrong on the other side too, right? So it is possible for these things to be implemented poorly and introduce not only tracking error, but just sort of genuine downside. We haven't seen that. The honest answer is most of these things are run very, very tight to their core indexes. Even Canvas, which has lots of variability, advisors can play with lots of sliders and add this amount of value or take this amount of growth and this amount of ESG. You can really get in there and mess with the portfolio. So you can do that. You can get in there and play too much, and then you end up with something that just looks like mud that doesn't really achieve your objective. So like any tool, if it's used willy-nilly and haphazardly, I think that's a mistake. If you're an advisor and you're signing up with one of these platforms, you got to get trained. You need to understand what the systems can do for you.
I think I heard earlier, I just want to make sure, you thought maybe for an account with $1 million or over is kind of where you would start using direct indexing and just kind of get into the multitude of tickers. Is that?
Yeah, I think that's where it makes sense. There are some hiccups here that I think people need to be aware of. Like if you're if you're an advisor and you're not paying attention and you just signed up with Schwab and you're either using their portfolio system or you're using Canvas through the Schwab accounts or something like that, if you don't check all the boxes just right, your clients could end up getting phone book statements, right? Which nobody wants, right? Because if you've got a 700 position portfolio that's doing some aggressive tax loss harvesting and there's been a lot of volatility, you could easily have 150 trades in that month, in that quarter. No client wants to get the phone book, right? They're going to call their advisor and be like, "What did you do to my account?" So you got to pay attention to some of that stuff to avoid some of those hiccups. But for the most part, once you cross into that couple $1 million, again, I'm talking about a portfolio of equities, not total net worth. That's where you can start saying, okay, with $1 million, if I held 500 individual positions, how much friction am I actually adding? And the answer is basically none. Right at this point, trading is so efficient that the intra trading between the specific positions in that $1 million portfolio is not going to add enough friction to matter. It's going to be a basis point.
Yeah, and I want to highlight something else I think you're alluding to, which is there are operational hurdles, meaning there's a lot of operational, I'll call it diligence, that advisors should do. And then B, right in the beginning, I mentioned, or we mentioned, a bunch of different direct index platforms. I don't think it's quite commoditized. That's a fair statement, right? Bob mentioned tracking error. There's all these elements that go into a manager, which you want to diligence as well. Is that fair to say?
Yeah, this is not a one size fits all thing, right? There really isn't. Whether you're an advisor looking at different DI platforms, there's real differences. And then when you're an advisor deciding who you should be applying this towards, there are real differences. One mistake I've absolutely seen advisors make is they get all excited to get on board with Parametric or Aperio or something like that. And then they go through their client list and they try to figure out how to sell it to every single one of them. This isn't necessarily going to make the advisor more money. This is about actually getting the client a better experience, right? Just like you shouldn't go get your insurance license and then figure out how much insurance you can sell to all your clients either. This is a utility that you're providing for your clients for the ones where it is appropriate. So I would tell most advisors, slow your roll on some of that rollout and focus the due diligence on what your clients' problems actually are and whether or not the thing you're buying actually solves those problems. So I am not a person who believes this is a thing every advisor should have. I don't think this is something that is changing the entire industry forever. I think it is a very useful, sharp knife in the drawer, particularly as you extend into some of the more edge case, like going long short and things like that, which I'm sure we can talk about.
We'll get into it. And then just finally wrapping up on, Bob mentioned, or you guys just discussed, running out of opportunities to harvest losses. Can you just kind of talk about how quickly tax output may dry up and kind of scenarios of up markets, down markets, how people should just generally think of?
Yeah, there've been a couple good studies on this. BlackRock did one, I want to say 3 or 4 years ago, where they sort of game theoried out a bunch of different versions of this. In that case, I think they were looking at both long only and 130/30 and sort of looking at what periods and it's very difficult to make a blanket statement on this, but there are definitely 3 to 5 year windows where you can effectively exhaust the losses in a portfolio. And then in the 6th year, you don't really have much you can do. That sounds like a failure. I feel obligated to point out that means you just have a normal index you're paying a little too much for at the end. It doesn't mean that your portfolio blows up or all of a sudden you owe enormous amounts of taxes. It just means you get to the end of that, you've gotten all of the free losses out of the way. Now you're kind of just running an index fund and you can make that low turnover and not pay a lot of taxes on it. And you're just going to get your dividend distribution. So it's not the end of the world when you exhaust a portfolio like that. And in fact, there's a starting to be burgeoning business of taking those so-called locked portfolios and then transitioning them themselves into a new diversified ETF through a 351 exchange. So there is a pathway even for those sort of locked up portfolios, as they're sometimes called.
Well, since you mentioned 351 exchanges, I wonder how RIAs should evaluate direct indexing relative to other solutions like Section 351 exchange ETFs or exchange funds.
Yeah, so solving very different problems. The exchange. Let me go start with what you ended with. The exchange fund, in particular, which is a totally different thing than an exchange traded fund or a 351 exchange. An exchange fund is where I take this giant position I have, like in Google, that I don't know what to do with, and I donate it. I contribute it to an exchange fund, which has its own set of diversification, its own fund, in exchange for some horrific lockups. Like, I'm not getting my money out for 7 years, right? So there's no free lunch in that one. That is saying I have a giant undiversified position I am willing to not look at for half a decade or more, and you put it in an exchange fund, and you do in fact end up with more diversification because you donated all the Google into this giant fund. So everybody else now has some exposure to your Google. That's a fine system for very narrow use cases, which is mostly not what anybody's talking about in this conversation. 351 exchanges, which is a different thing, are when, and I'm sure you guys are going to get Alpha Architect on here at some point if you haven't already. It's when you take a already diversified portfolio and you use it to seed a new ETF. Right. So I take my basket of, 20% Google and then a whole bunch of other stuff that is still a diversified portfolio. I hand it off to somebody like Alpha Architect. In return, I end up with shares in a new ETF that looks pretty much like the S&P 500. And there's no taxes in that transaction. I keep my tax basis. So if I could then go sell that diversified ETF, it's as if I had the tax basis from my original holdings. So there's not a free lunch in that perspective. It just lets me shift to a differently diversified portfolio without that tax hit right then. Eventually, if I want to turn that money into utility, if I want to go spend it, I still have to sell it and pay the taxes on it.
Yep. We had Brent Sullivan as a guest here, and we covered.
And you got all of it. He's the best.
You mentioned earlier that direct indexing doesn't make sense maybe for smaller clients. Are there other situations where direct indexing just won't make sense?
Yeah, I think, not everybody is in a super high tax environment, right? I mean, if a lot of folks who, maybe have, are in Gen X and have come up through the tech boom have been very smart in how they've managed things like their Roth conversions and things like that. If you've successfully managed to shove a lot of this into tax deferred money, none of this really matters to you unless you're really hung up on the customization for some other reason. But the tax advantage goes away if you've done a good job on managing those taxes sort of going forward. I'd also say that this isn't a solution, like it isn't the point solution for the single stock problem. It is part of a toolkit for that, but it does not solve it automatically. And it very well may be the case that you have clients with this high concentration problem who have restrictions, who have, can't move that exposure into a portfolio like this, can't really be on a systematic sell down program. They're going to be a poor fit for this. You're going to have to find other ways to do this. You're going to have to go through all the traditional mechanisms of, can we donate it? Can we put it in a trust? Can we pledge it and borrow against it and then hopefully die? Like all the normal ways that people deal with this.
And now let's talk a little bit about the end of life of a direct index strategy, whether a client wants to terminate it, or assume that's the end of the life. How does one proceed with that? Imagine there's like lower cost basis because of tax deferral. Can you talk a little bit to kind of closing out?
I mean, there's nothing inherently fancy about it, right? I mean, at the end of the day, every one of your clients just has an SMA, right? What trade happens next in that SMA has nothing to do with the direct indexing provider or anything else. It's still just a custodial account sitting at Schwab or wherever it is, right? So the quote unquote closing of that account is mostly an issue of where you're going to take what kind of tax hits. There's nothing restricted about these accounts. You can take your $10 million DI account, sell all of it, and buy a yacht tomorrow. It's the only question is how much are you going to pay Uncle Sam? And that's only a complicated question to the extent you've already used up all your losses, right? So if what that means is you end up with a portfolio of 500 stocks where every single one of them is sitting on an unrealized capital gain. Well, that's just the world that you're in. There's not a magic solution to that. Potentially with the exception of something like a 351 exchange where the whole portfolio goes into a new wrapper and you get diversification. Again, minus the things rich people already do when they face this problem, like donating appreciated shares, pledged borrowing, etc.
And what is, in your view, the optimal way to explain for an advisor to explain direct indexing to a client?
Um, I just use the tax example because I think people get it, right? I'm sitting here at two stocks in my portfolio. I've got a 50% unrealized gain in Nvidia and a 50% unrealized loss in, I don't know, ancient JDS Uniphase shares. I don't know what it would be, right? That's a really common thing that advisors understand, that kind of raw matching losses and gains. Every advisor, I would hope, should have some basic facility with that. I mean, I don't think I've ever talked to an advisor who doesn't understand at least what tax loss harvesting is, right? They may have been doing it poorly by swapping out their S&P funds at the end of the year, but they've been doing it. They're aware that it exists. So this is an optimized, personalized tax loss harvesting program for most of your clients. That's the easiest way to pitch it. Most of the time, the pushback is then, do I really need that? That's not the core of my portfolio. And then you mention, well, but I'll bet you have a few clients whose 70% of net worth is in one ticker and they're all not, right? And that's a different conversation.
Got you. And what are some typical client objections coming back to the advisor?
Complexity, and that's a legitimate one, right? That is just true, right? You take your client from having 7 or 8 line items on their statement to 400 or 500. That is a complexity issue. And yeah, software makes that easier. It's no longer the tax nightmare that might have been. Like now computers do all our taxes. Nobody has to fill in all the individual position reports, right? So the complexity is real for advisors that do not have any relationship with a tax practice at all, meaning that their clients just go do their own taxes. I think it's a poor fit because you need an accountant who understands they're going to receive a fairly complex statement at the end of the year that's going to be part of those taxes. So for advisors who are either tied up at the hip with a CPA practice or are have a strong referral network of CPAs, I think this makes a ton of sense. If you really don't like dealing with taxes, you shouldn't be touching this.
Overall, based on your experience, how successful has direct indexing been, specifically with respect to diversifying a concentrated position?
I think it's been very successful I think it's appropriately successful. Let me put it that way. I do not get the sense that there are a ton of people in DI platforms who shouldn't be, nor do I get the sense that there's a class of advisors who have just said never here and are missing the opportunity. When we talk about direct indexing growing up to about $1.5 trillion-ish now, something like 10%, 8 to 12% of the ETF industry, that feels about right. Like that doesn't feel to me like there's been no adoption and this was a scam and nobody paid attention, nor does it feel like, the next crypto boom or it's the only thing we're talking about. It feels like an appropriate use of the tool set. Where I think there could be some issues is the juiciest end of this, which is long short, right? That requires something else. That requires somebody to offer to loan you money to do the short side of these trades. That means there's capital restrictions. So the long short version of this does in fact work, and it is very, very juicy, and you can in fact do way better than you can on the long only side, and you can do it kind of indefinitely because if you're long short, there is always something at a loss almost by definition. So you avoid a lot of that locked out portfolio problem. The problem with long short is obviously you're taking a very much larger chunk of risk. Anytime you're going short something, you run the risk of being wrong in both directions. So it can really blow up on you. The folks who offer these tend to be very sophisticated and very structured and controlled. So we haven't had any big blowups that I've heard of there. But that edge, that long short edge of direct indexing is where both there could be more problems and B, where we're going to run out of capacity. We already have. Folks like Fidelity have stopped opening new accounts for long short because somebody has to provide that capital. Usually it's Fidelity or Schwab, and they're starting to gate it.
How much tax alpha can advisors realistically expect to garner from direct indexing compared with simply holding the concentrated position, paying whatever the capital gains tax might be at the federal and state levels, rather than engaging in a solution that would defer that tax payment?
I would be very conservative on this, and I would say most advisors should be thinking about like 1 to 2% a year. I don't think it should be. I don't think you should be expecting more than that. And on on a particularly sort of monodirectional, high internal correlation market, you might not even get that, right? Because there's just not enough room to create those losses and create that diversion, sort of the internal dispersion trade you need to really make this work. We're in pretty volatile markets right now. I would expect it to be working very well this year. There's a lot of stuff that is, companies like Corning Glass down 50% this year. There's lots of big, boring losses that pretty much anybody in a DI platform has sitting there at, 30, 40, 50 basis points of their holdings that they don't even know about that are sitting at 50% losses. So I suspect this will be a very good year for people doing tax loss harvesting, but you should not expect that every year. So I would say 1 to 2% if you're doing it on a long only basis, maybe 3 to 4 if you're doing it long short.
And Dave, what are some of the big mistakes that you've seen advisors make when it comes to direct indexing?
I think getting too clever. The most advisor friendly platform I've personally put my fingers on and played with is the Canvas tools that they have. I've seen the Aperio ones. I think they're very similar. You can get in there and really mess things around. Like you can get in there and say, okay, we're going to start with the Russell 1000, but then we're going to put this value tilt on it. And then when we're going to do international, I'm going to say, I think emerging markets looks like this. So these 6 ETFs represent that. And then, by the way, we're not going to have any fossil fuel stocks in them and no stocks that begin with the letter T. You can get in there and get really sort of silly about where your exclusions are and your overweights are. And in many cases, the more complicated you make it, the higher the fee goes, right? Because if you're going to layer in some stuff that's supposed to add value, somebody's probably going to charge you for that. I think that's a mistake. I think that direct indexing works best when it's very simple, right? When it's selling your losses to cover your gains, and you're managing down large positions back towards index weights. That's when I think it makes sense.
And, we referred earlier to these long shorts. Are we going towards packaging solutions, being more holistic with choice? And yeah, go ahead.
I'm a skeptic that we're going to see long short as a strategy take off inside like an ETF wrapper. We've had plenty of these products out there. Like Wisdom Tree, I think, had NTSX like 15 years ago, which was like a 90-60 portfolio. So these things work. The challenge is that a long short portfolio by itself is no guarantee of alpha, which means you better be managing it for the tax side. And if you're managing it for the tax side, it's very tough for me to suggest you do that in anything but a custom wrapper, because everybody's taxes are individual. And there's such a huge difference between somebody with great trust accounting living in Florida and somebody who's just a high income earner in California. Like radically different tax situations, radically different products required, completely different financial planning problem, even if they're exactly the same age and had the exact same theoretical lifetime net worth. So I am skeptical.
And what trends do you see shaping the future of tax management for RIAs?
I think a lot of the stuff we're talking about gets cleaner, meaning I think that you're going to see people offer services around this. I would expect to see more and more integration between tax and investing. You're seeing that already. I think it's a real trend among advisors that are getting closer and closer to tax practices, particularly as we have a real dearth of CPAs being minted. It's not quite as bad as the nurse shortage, but we ain't met a lot of CPAs either. And you still need somebody to sign your complicated investment tax return for your $20 million client. Somebody's got to sign that thing. And it's not going to be the client. So I think that repackaging of tax-aware investing will become cleaner and easier to understand, and we'll have better language around it, and we'll have monographs from the CFA that make more sense. From a product perspective, I don't see anything on the horizon that I think is a huge change. There's some noise about 351s and whether the Treasury is going to get all upset about them because they made some comments last week. I'm a seller on all those narratives. I don't think we're actually going to touch any of these structures. I think we're going to do some regulation by hand wringing so that people can feel like they've at least pointed something out, and absolutely nothing will change. So I don't think there's any big regulatory risk here.
Dave, tell us more about ETF.com. What can advisors or readers expect to learn from your site? Who is your primary audience, and what are the big questions that you're trying to answer?
Yeah, so I think look, Bob, you and I've been in this business for a long time. We've been putting pen to paper, talking to advisors since Christ was a baby, and that world has changed, right? And I think we have to acknowledge that in the world of AI and ubiquitous information, the role of a narrow site like an ETF.com is different than it was a decade ago, where really the value might have been big, long form, researchy, thinky pieces. Now, increasingly, what we're finding is we're surfacing the conversations for advisors, and then they're going to go take the next step. So what you see at ETF.com now versus a decade ago is a whole lot more video, a whole lot more one-on-one conversations, not just with people trying to sell you something, but with financial advisors who are solving problems like this, with people like Brent Sullivan talking about the issues that they're actually digging into day to day on tax management. So lots more video. And then honestly, bringing advisors together to talk to each other. So we're sort of part of the group of companies now that are part of Future Proof, which is the big events in Florida and in California. The next one coming up at Huntington Beach in the middle of September. And so ETF.com sort of standing up our own little mini conference in the middle of those events, where we've got our own content stage. We've got ETF issuers putting up cabanas and playing beach games and things like that, but mostly creating a space for advisors to come together and really wrestle with some of these questions with each other, with the issuers there to answer the questions. So that's I think the pivot that we've seen at ETF.com. I think it's a pivot we're seeing in a lot of financial media as it moves from just answering questions to making connections.
Dave, this has been a great conversation. As a closer, in a minute or less, every RIA listening remembered only one thing about direct indexing, what would you want it to be?
It's a sharp tool in the drawer. That's all it is. It is not going to solve all your problems. It is not going to kill you. It is a sharp tool in the drawer. Just make sure that you are looking carefully when you put your hand in it.
Thank you for listening to Advisor Wars with Bob Hoopsher and Joe Halpern, and today featuring our guest, Dave Nadig. To learn more about Obsidian's CIO and Joe's work, we'll include a link to his contact information and a link to the firm's website in the show notes. You can also find Advisor Wars on Apple Podcasts, Spotify, and YouTube, and we will include a link to connect with us on LinkedIn. Stay tuned for our next series of episodes, which will be focused on trust and estate planning. Our first guest I'm very excited about is Bob Keebler. He is one of the top experts and thought leaders in the world of trust and estates, and he will be talking about some of the latest developments in the field that he has been so deeply involved in. Thank you.
Obsidian CIO sponsors the podcast to further educate and provide critical thinking about the factors that affect markets and investing. The podcast does not provide investment advice. Investment advice is offered only to clients of Obsidian CIO who have entered into an advisory agreement with whom Obsidian CIO has identified individual objectives, risk tolerance, and other investment needs. Thank you.